Zach's Know Your Options, a weekly overview of unique option strategies and ideas designed to help you beat the market no matter which direction it's going. Well, given the market uncertainty of late, we thought, at least our options guru thought, that it was going to be a good time to talk about a strategy involving the iron condor. And so we've invited him here to explain himself. Kevin Matras is the options guru that I'm talking about. So you and I have talked about this in the past, although not lately. A lot of people don't know what this is. So for those who don't, let's help them out.
Yeah, it's funny. I think whether you trade options or not, I think this is one of those strategies that a lot of people have probably heard about, but probably most people have no idea what it is. It's kind of like the Bigfoot of option strategies, right? Often talked about, never seen. But I can assure you it's real. That's why we're going to be talking about it today.
Well, I thought you were going to come in with your, bandana, your headband on or something.
Right.
Call yourself Mr. Miyagi or something when I saw what we were talking about. Iron condor option strategy. So why would somebody want to use this?
Well, first off, this strategy can be classified as a neutral strategy, right? So if, let's say, you have a bullish bias to the market, that means you're expecting the market to go up. If you have a bearish bias, you're expecting the market to go down. So those are basically directional trades. The iron condor, being a neutral trade, basically has you just identifying a range, right? So the market can go up, or the market can go down, or the market can go sideways, and you have the ability of making the exact same maximum profit potential regardless of which one of those three directions it goes in. And the thing that's cool about that is that it's a low-risk trade, so during this market volatility and uncertainty, people are looking for ways to be able to make money, and they want to do so with less risk. So this is a low-risk trade, it's a high-probability trade, and again, the iron condor is usually put on as a credit spread. So you're actually getting paid to put this one on, and that's kind of cool.
All right. So just looking at what I've got here, it looks a little bit more involved than the overview that you just gave. So set it up for us in language that we can all understand.
Okay. First off, there are 4 parts to this trade. They're actually quite easy, but there's four sides to this. And the best way to explain it is to go over an iron condor trade that I literally just put on yesterday, and I did this with a stock called Interoil Corp, ticker IOC. All right. And again, as you had said earlier, given the pullback in the market, given the uncertainty, these market neutral, these neutral type strategies, fantastic way to participate in this environment. But here we go. So yesterday, when IOC was trading at about 70 bucks, I ended up buying to open 1 August $85 call at 247. So that was a $247 debit. And I also sold to open 1 August $80 call at 346. So I got a $346 credit. I also then sold to open 1 August $60 put at 312. That was a $312 credit. I collected that. And I bought to open 1 August $55 put at 191, and that was a $191 debit. Now
yesterday was the 26th of June?
Yeah.
Right? Okay. All right.
What date's today? Thursday? Yeah, it was Wednesday.
27th today?
Yeah.
Right, okay.
So essentially in iron condor, as you can see, the way I grouped those, the call side and the put side, basically an iron condor is 2 spreads, 2 credit spreads. You have a credit spread on the call side and you have a credit spread on the put side. So on the call side, you can see that we collected $99 on the call side, we collected $121 on the put side, and that totaled up to be a total credit of $220, okay? Now, your maximum profit on an iron condor is always going to be the credit that you received, okay? Now, in this example, it's $220. Now, the way we profit, though, is you want to be able to see IOC at expiration stay within those inside strikes. So again, like I said, when I put this thing on, it was at about 70 bucks. Between now and expiration, which I believe is August 16th, I want to see IOC trade no higher than 80 and no lower than 60. As long as I stay between 60 and 80, that is going to give me my maximum profit potential. So when it was at 70 bucks, I had a $10 cushion on the upside, a $10 cushion on the downside. And if you think about it, that gave me the ability of seeing IOC go up as much as 14% or even down as much as 14%, or of course going sideways. And I would make the exact same profit potential. And that's pretty cool because that is a pretty wide range. Now, the way you would lose on this is if IOC at expiration closed above the further out strike, which is above 85 bucks, or if it closed below the lower further out strike, which is 55. At that point, I would lose the maximum, which would be 280. But that's still a relatively small risk for this kind of strategy.
All right, so talk to me about how you would win here.
Okay, so as long as you stay between 60 and 80, so let's just say that at expiration, IOC closed up and you closed on the high end of the range at 80 bucks, okay? So let's take a look at these slides. This is what will happen. Very similar to the slides we just looked at. The $85 call we bought at 247 would expire at 0, which means we would have lost the entire 247. But the $80 call we wrote at 346 would expire at 0 as well, but since we wrote this, we're keeping that 346. So again, we've got a net gain of $99 on that call side. The $60 put we wrote at 312 would also expire at 0. That's a $312 gain. We're keeping that. The $55 put we bought at 191, that would expire at 0. That's a $191 loss. So once again, we have a net gain of 121 on the put side. You add both of those sides up, and you've got a total gain of 220.
Okay.
So again, as long as you close within that range, 60 and 80, you have gotten your maximum profit potential. And again, though, if you close outside of those strikes, that's where your loss comes into play. So let's take a look at that.
All right.
Okay, let's move to the next slide. So let's just say between now and expiration, let's say IOC closed down, and let's say you closed at 54, which is just a little bit outside of that low end strike, right? 55 is our threshold. Let's say it went down to 54. Here's what will happen. The $85 call we bought at 247, once again, expires worthless, we lost 247. $80 call, we keep the 346, once again, $99 gain on the call side. Here's what happens on the put side. The $60 put we wrote at 312, that is now in the money, which means that put would now be worth $6. But since it's in the money and we wrote it, that's working against us. So we would actually lose $288, right? $688 or $6 minus the 312, we lost $288 on that one. The $55 put we bought at 191, that is also now in the money, but that's only worth $1. So we ended up losing 91 bucks. So it still had some value, but we lost a portion of what we paid for that option in the first place.
Yep.
So the way that works is, if you were to take a look at those two sides, we have a net loss of $379 on the put side, a gain of $99 on the call side, but that equals a total loss of $280. The easy way when you're trying to determine your risk to reward ratio is to just think of it this way. Your maximum loss is going to be the difference between the maximum spread on either side, and in this case it's $5, right? 80 to 85 is $5, or 60 to 60 or 60 to 55 is $5. So it's the maximum spread less your credit. So the maximum loss in this case on the spread would be $500. Less the 220 credit, that would be a maximum potential loss of 280, and that is how you figure that out, okay?
All right. I'm just trying to follow here, so.
Okay. Let me also say, too, the cool part about a neutral strategy like this, and it really is good to be able to look at this on a piece of paper when you're trying to be able to fully understand it. But again, it really is just two spreads. But once again, the real benefit and the reason why this is it's a trade that is comfortable to put on is because the stock, you could be wrong. The stock could go up to infinity, or the stock could go straight down to zero, or just go sideways, and you're still making money. But the worst case scenario is you always know what your maximum risk is going to be going into it. And again, usually it's relatively small. So that's kind of cool.
Okay. So increased probability of success here?
Yeah, there is a very high probability of success. By the way, let me also show you a chart though. When I put this one on, you can kind of see those bands that I put on here. So you can see IOC was trading at 70 bucks. If you take a look at that thicker line at 80, that's the top end of our profit range. That thicker band at 60, that's the bottom end of our profit range. And this is where we want to stay within. Now, one last thing I do want to say is generally when I put on an options trade, if I am putting on a directional trade, I typically want to see a 3-to-1 reward to risk ratio. But for these types of trades, you're oftentimes going to be putting these trades on at like a 1-to-1 reward to risk ratio, or maybe slightly under a 1-to-1 risk to reward ratio, which is what this one is, right? Maximum gain 220, maximum loss 280, so it's just under 1 for 1. The reason why I believe that this is acceptable is because with this strategy, you have 3 ways to win. You do a directional trade, you have to see this thing go up a certain amount, otherwise you lose. Put on a bearish position, it's got to go down a certain amount or otherwise you lose. And if you buy a directional trade and this thing goes sideways, you're going to lose as well. Here, you've got a wide range. You can go up, down, sideways. You could be totally wrong on what you think it's going to do. As long as you've defined that range accurately, you're going to be a winner. So there's really 3 ways to win. So even though the actual reward to risk ratio is approximately 1-to-1, I've got my 3-to-1 probability of success because I've got 3 directions that I can benefit in. And that's why I think this is a fantastic strategy. The other thing, too, is a lot of people don't look at these types of things because usually when somebody buys an option, they look at these options as lottery tickets, right? I'm going to spend 300 bucks and I potentially could make $5,000 on this trade, which of course almost never happens. So they just keep on buying these lottery tickets over and over and over again, and they find themselves blowing up their account. Here, it's not exciting, right? Oh, I'm going to make 220 bucks sitting around waiting for the stock to, stay range bound for a month and a half or 2 months. But if you put a bunch of these on that are such high probabilities, those things add up and they add up quickly. That is why it's so exciting. And also, too, this is why professional traders find themselves doing these types of trades far more than just going out buying calls and puts, hoping for some miracle.
All right, and just to clarify, seems to increase the probability of success, one of the things you need to do is establish a wide enough range.
Yeah, so if, that's a good point. You want to pick as wide of a range as possible, so the wider the range, the higher your probability of success will be, but of course you want to be able to get a large enough credit. So you really have to kind of balance the two. If I have a really wide range, the wider the range, the smaller the credit, the closer the range, the bigger the credit. So you need to be able to juxtapose those two things, and that's why I believe trying to establish a 1-to-1 reward to risk ratio is probably the compromise you want to see. So once you see the credit you can receive is going to be commensurate with the risk you have to take, that will immediately identify the appropriate range, and that is how you'll know that you've got probably a high probability trade to put on.
Quickly, anything to watch for?
Yeah, you just, again, you want to be able to make sure that, that you don't look at the largest credit possible. I mean, if you're thinking to yourself, okay, I can make $1,000 credit, just know that you're probably going to be taking a commensurate risk. But the thing to look out for is don't get greedy on these credits. You need to be able to give this trade enough room to breathe. And it's kind of hard to find these things. I mean, when I found IOC yesterday, you know, being able to see a 14% breathing room on the top end and 14% on the downside, that's pretty good. A lot of stocks and option strategies that you'll see with the Condors, sometimes you only get maybe 1 or 2% breathing room. My goodness, you could just blow that trade out within one afternoon.
Yeah.
So you really have to do your due diligence and look at that reward to risk ratio. Don't get greedy. The whole key with this type of strategy is to put it on and give yourself the highest probability of success. That means no greed.
All right, so a lot of information that Kevin just went through to digest with this particular strategy. And if you're out watching this in syndication land, you can always get over to Zacks.com and see the accompanying text article that goes with this video if you're not seeing it where you're watching it right now. And that's all in the options section of Zacks.com, where there's a lot of other information too. Information to help you know your options. With Kevin, I'm Terry Ruffalo.